All right, welcome everyone. I'm Chris Miles, cash flow expert and anti-financial advisor. Welcome you guys out tonight. Love seeing all you guys on here. It's 9 o'clock where I am right now in Tampa. I know some of you guys it's more like 7 o'clock, so appreciate you guys being on dinner time or afterwards. So because I'm going to make sure we make it well worth your time because I love getting right to the point. And I love to teach you some good stuff. And after I teach some stuff, I'll definitely open this up for questions too, so you guys can have the opportunity to do that as well. So excited to have you on. Lauren, excited to have you from Idaho Falls. We got New York City. We've got Connecticut, or originally from Connecticut. We got several from Utah. So grateful to have you guys here. So I'm going to get started here. I'm going to share my screen right now. I know you want to see my yellow, beautiful hotel face, but I figure we'll get past that part. So all right. So you guys should be seeing my screen right about now. Let me go ahead and get this thing going. All right.
Well. Look who's here.
Well,
Sorry
hey,
I'm
Gary.
late. Sorry, brother.
Well, I'm glad to have you on, one way or the other.
Oh, yeah. Thank you. I'm really sorry I'm late, guys. Just technical fun difficulties in a vehicle. All right. We're all good.
Okay. Well, cool. Should I just rock and roll then? I have your permission?
Why don't you do that? We really appreciate you being on with us and really want to. I know that just for the record, everyone, if you don't know Chris Miles, you need to know Chris Miles. Get onto moneyripples.com, learn about his podcast. The what's your show called? It's on Cashflow show. No, Chris Miles Money Show.
Remember the Chris Miles Money Show.
That's correct. Excellent information. And Chris has been a good friend of mine for going on about 7 years now that we finally met in person.
Yeah.
And good man, and he knows his stuff. He's helped many people, a lot of investors, especially throughout the country right now, which I know is why you're in Florida right now, networking with investors from around the country. And just wanted to have you on to share your expertise on how people can really learn to get paid twice. And I just want to thank you for joining our little group here. I'm going to share this with some of the people in my network, and take it away, my friend. Appreciate you.
All right. Well, yeah. So let me ask you a question for you guys. How many of you guys love leverage, meaning that you like to get paid as many times as possible? Go ahead and type that in your chat if that's the case for you. Who in here likes leverage?
I sure do.
That's right. I love it. Me. Well said, Gary.
No way, just kidding.
I know. So by the way, in honor of that, I actually wear my dear friend Tiffany Peterson's shirt saying, why not, there we go, why not have it all, right? So
Nice.
That's exactly what we're going to be talking about today. So cool. So yeah, so like I said, I'm a cash flow expert. I'm an anti-financial advisor. So let me tell you what that really means is, I started out actually being the traditional mainstream financial advisor. So I've actually been in the business now for 17 years. Good grief. It's been a while. Since the basically since Y2K, right? Or since 9/11 time. That's when I started doing financial advising, did that traditional stuff for 4 years, teaching all the same stuff, how to, save everything, spend nothing, sock it all away into mutual funds, and hopefully someday you'll have a retirement, and if not, your life will suck, and that's pretty much what it's like anyways, right? So that's pretty much what it's been like, and I was teaching all about accumulation, right? It's like save your way to wealth, and even back in those days, I taught about selling things like variable universal life or index universal life. I was one of the leading adopters, the early adopters of that. And but you know what? Like after about 3-4 years, I started to question everything I was taught because it's interesting because I would get people's clients. I would inherit clients from people, and they'd say things like, "Oh, so you're my financial advisor now? Well, I hope that guy's in prison." This is, of course, after the Y2K, the bubble burst, right? With all the tech stocks, everything. These people were hoping for retirement after the late 90s. And then when the 2000s hit, basically nobody had any faith in the stock market would get them to retirement. And I realized that as I start to look at the numbers and really analyze stuff, I realized that the stuff you've been taught as a financial advisor won't work. and the stuff that I was teaching other people. And I remember it was actually one of my friends who decided to leave financial advising. He became a real estate investor. And I remember after 4 months, he did that. He was going partnering in deals with his dad. And I asked him, like, well, how are things going with you? This is like the end of 2005, right before New Year's of 2006. I'm like, how are things going for you? He said, oh, it's awesome. And of course, I'm disappointed because I called him up thinking he's suffering. He wants to come back and beg for work again with me, to work as a financial advisor again. And didn't happen. He actually said the opposite. He's like, you know what? Like, it's been awesome. My dad, who's a professor at a local university, he's doubled his income doing this real estate stuff. And I'm like, oh, come on. That's bullcrap. That's, as you might have heard, for those who do real estate investing, that's too good to be true, right? And so we got in this little debate about what's better, stocks or real estate, stocks or real estate. And finally, he just said, Chris, what principles do you teach your clients? I'm like, what do you mean by principles? You mean like Rule 72, compound interest? He's like, no, not even close. All right, well, what do you mean? He's like, well, how about this? How many of your clients are actually financially free? Like, they don't worry about money anymore. And I'm like, none, maybe one. She's a doctor, but then watches CNN and freaking out, and like wondering if she's gonna have money. So he's like, well, that's stupid. Well, that didn't work. Good job, Chris. Okay, Chris, how about this? How many of you financial advisors are financially free, not off the commissions you're earning, but actually doing the investments you've been recommending, actually living what you preach? And I thought for a bit, and I thought, none, maybe one. And I found out that one wasn't either when he got fired from that company a couple years later. And that's the thing, guys. Like, he had me stumped. He's like, all right. I'm like, okay, fine. You got me to admit it. I suck, right? Or whatever. So tell me the answer. He's like, I'm not going to tell you the answer. I'm like, Dad, gummit, tell me the answer, or I'm gonna break your kneecaps or something, right? And so he finally said, listen, if you're serious, there's this local radio show on. Listen to this. There's a bunch of millionaires that talk on the show. He's like, and then go get the book Who Took My Money by Robert Kiyosaki. He was a follow-up to the Rich Dad Poor Dad series, right? So I did. I realized that mutual funds were dumb and all that kind of stuff, right? And so, I started looking at things like real estate and doing alternative investments, and even things within my business. I started focusing on cash flow, on acceleration, not accumulation. And what happened is I quit being a financial advisor in March of 06, but I was able to retire by July of 06 with only a few $1,000s in my checking account, because I realized that having cash flowing and passive income streams are the key. I didn't have to have all this money saved up like I thought. Like, we had to save up $2 million and then live on that 2 or 3% interest that now they're recommending you do. It used to be 4% back in the day, but nobody believes in that number anymore. So they say live on 2 or 3%. I mean, do you realize if you have $2 million saved up, living on 2 or 3% is $40,000 to $60,000 a year? That's crap. That's like barely above at being broke, And so I changed, and I started to see a shift. And that's kind of where I'm coming here. And I started to learn some different strategies. And over the years, I started to perfect some of these. And one in particular is about how to basically double dip your returns, right? That's what they're going to do, because these other guys, they don't get it. Or Dave Ramsey's of the world. Trust me, like, in some ways, they're right. If you go by the mainstream stuff you've been taught, like for example, we're going to talk about things like whole life insurance. Dave hates it. And you know what? Based on how everybody's using it, or a lot of the people have been taught to use it, he's totally right. It sucks. It's a waste of money. I'm going to show you a little bit different strategy today that will probably be different than anything you guys have seen before. By the way, I'm not the first one to use this. This has been used for years. Some of you guys might even know some of the strategy, or at least to some level. Obviously I know that it works to some place, but it can also not work. But banks have been using this forever. And in fact, a lot of times they keep at least 20-25% of their reserves in this kind of strategy that we're talking about here. So here's how you can double dip your returns. You guys ready for this? Okay. I'm just going to go for it. I'm not even waiting for your response. Here's an important concept you got to learn in order to know how you can double dip. Okay. 2 options. You can either use cash, or 2, you can borrow it. So you can use cash or borrow it, right? That's really the only thing you can do. I mean, if you think about it, oops, let me go back there. So, I mean, for example, you want to buy a car, you can either just pay it in cash, and at least you'll say, hey, great, it's paid in cash, it's paid for, it's done. Or you can borrow the money from the bank, you pay interest to them. Here's a key point. You are always, always paying interest. Always. Whether you use cash or you finance it through a bank. Now you might be thinking, wait, well, of course, at the bank I get that, but what do you mean by with using cash? Here's the thing. When you use your own money, when you use cash, there is an opportunity cost there. That money now can no longer make money for you, right? So if you pay for a car in cash, you can't go use that money to invest and make cash flow, can you? And so you're always paying interest. The question is which one is better for you? Which one allows you to either save the most or make the most, right? So I'm going to give you an example here. We're going to talk about two different types of interest, compound and simple interest here. So let's just say you have a $200,000 mortgage. And by the way, I was taught this, funny enough, it was actually by a life insurance agent who was just trying to sell me on the concept of some of the life insurance stuff. But I realized that this can go much, much bigger in the sense that this can allow you to create more. So say you have a $200,000 mortgage. You get a 30-year mortgage at 4.5%. If you just pay the minimum payment for the next 30 years, you'll pay $164,000. Now, I remember in the mid-2000s, I was actually a mortgage broker for a few years. And I remember showing people this number. I'd say, hey, look at this. Oh, you're almost paying for 2 mortgages over the life of this loan. So, hey, pay this sucker off faster, right? By the way, all the banks, those are the ones that taught us to do everything, aren't they? Because think about what a bank wants, right? Banks want your money how often? As often as possible. How much of your money do they want? They want all of it, right? How much, wait, what did I say? Yeah, how often they want your money? They want it all the time. They want as much of it as possible. They want, of course, keep it for as long as possible. They want to give as little back as possible. And the fifth rule is that they want to take as little risk as possible. So, of course, if you have a loan, they want you to pay that back faster. I used to think it was opposite. I used to think that banks wanted you to stretch out the interest forever. Well, that's not true. They realize that acceleration, speed is what's key, not accumulating money. And so anyways, you pay this 30 years, you're going to be paying $164,000 of interest. Now, here's the question. That's a 4.5% interest rate, right? So what if you had the $200,000, you could liquidate and cash out and everything and pay off your mortgage today? Because really today is the most you can save. I mean, putting a little extra, you throw an extra few $100 in your mortgage every month, that does almost nothing. That barely gets you to pay it off early. But if you could pay it off today, that's the most money you could save, which we know is $164,000. So what if you have the $200,000 that you could drop and pay off your mortgage today, but you don't? Instead, you save it. And say you put in a CD, and CDs right now, some of the highest ones I've seen are at 3.5%. Now, go ahead in the chat here with the responses. In the chat, go ahead and put in, what do you think that $200,000 will do in 30 years at 3.5%? So remember, 4.5% on your mortgage costs you $164,000. What does 3.5% make you on $200,000 in savings? Let's go ahead and see. Just put out your guesses. This is like Price is Right, Bob Barker, or now Drew Carey, right? This is like Price is Right. So go ahead and put out your numbers. Just tell me what you think at 3.5% for $200,000 mortgage. Wait for that first one to come in. What's that first bid?
I've seen a 125. I've seen a 123.
Yep, 125, 123.
100K.
Do we have anybody betting $1? Awesome. Here it is. $361,358 and some odd cents that I dropped off.
Wow.
Now you're probably wondering, how in the heck is that? How does that even work, right? Because we just saw 4.5% was $164,000. How is it you're making almost $200,000 more, earning 1% less? What do you guys think? For some reason, I'm not seeing the chats. I'm not sure why. Oh, here we go. Increasing balance.
Compounding.
Anthony, you're on the right one. Dave, you said compounding. Increasing balance versus decreasing balance. Yes. Cool. That's pretty much what it is, guys. So when I talk about two different interest rates, there's two different ones, right? there's compound, and then there's simple. Now, compound, if you think about compound interest, it's like a snowball that gathers growth over time, right? It goes up and up and up. So, for example, you earn, take $100,000, you earn 3.5%, you made $3,500. Well, the next year, you're not making $3,500 because now you have $103,500. So now you're going to earn 3.5% on that. So now you're going to have like 107,000 and change. Then you earn 3.5% on that, and this gets bigger and bigger. There's more and more interest that gains. But when it comes to loans, loans are simple interest. Simple interest go down over time. They're like that blue area. Green is like the compound interest, while blue, it goes down over time. You guys have probably seen this before. Like whenever you've had car loans, for example, you notice that with every payment that you make on your car loan, more and more goes to principal and less goes to interest. Now, that's not because the interest rate drops. It's just simply because is that as you're paying down that balance, as what Anthea just said earlier, you're paying down the balance, now there's less and less to charge interest on, right? And so that's why. By the way, you want to know something mind-blowing? That same $200,000 at 4.5% interest, just earning the same as the mortgage interest rate, right? That number is now netting you, after you pay off the interest and everything, over $400,000. Guys, see, if you did nothing else but just understand this concept, this is why you don't want to pay off your low-interest cars. You don't want to pay off your mortgages early. This is why you want to get your money working for you instead of against you. Because throwing money onto that stuff actually will cost you money. That's where you're paying interest the opposite direction, the opportunity cost. Can you imagine, for those of you that know you can make more, by the way, like I know with all the clients I do like consulting work with where I strategize how they can retire early, like a lot of times we're looking at 10, 12, 15% minimum. I know guys like Gary's doing some deals that makes way more than that because he's an active investor, not just a passive investor like many of my clients want to be. Right? And so you think about how those numbers are mind-blowing. That could be making you millions of dollars right there. By the way, if you want to know the break even on a 4.5% interest, all you have to be earning on that $200,000 over those 30 years is roughly about 2.1%. If you earn about 2.1%, what will happen is you'll actually now, that 2.1% will grow to be about the same, the $164,000. So basically, and even a 5-year car loan, as long as you earn half the interest rate of what they're charging you, you're at least breaking even on the interest they're charging you. So if it's a 3% car loan, all you need to do is make 1.5%. If it's a 5% car loan, you just need to make 2.5%, and so on. Now, guys, this is key. I remember in 2006, one of the things that, end of 2006, beginning of 2007, I was launching a new business. I was partnering up with some guys. Maybe you guys have heard some people like Garrett Gunderson. He teaches some concepts and whatnot. I actually partnered with him back in the day, or in those early days. And we were launching a business together. And I remember going to my bank and saying, hey, I've got $25,000 just sitting in my bank account. Can I get a line of credit against this? And of course the bank said, well, duh, yes, of course. At that time, the credit union was paying 1.5%, right? Because back then we were getting paid quite a bit more. Now they charged me. They said, yeah, we'll only charge you 4%. Now those numbers wouldn't exactly work with the compound for simple interest, but they were really close. But I was able to get 25 grand out, used it to launch a business. And by the way, the minimum payment was like $126 a month, $130 a month. If I can't make $130 a month with 25,000 for, I shouldn't even be in business, right? And so that's what I did. Now I was leveraging the same way. Now you could do this, but instead of doing, like what you do with banks now, we're getting paid 0.0% on it, and you're getting taxed on that 0.0%. How would it be? How many guys would be so cool if you could have a tax-free, high-yielding, supercharged savings account? How many guys would love that? Well, that's what we're talking about here. So the vehicle, I can use a savings account, of course, and earn nothing and then get taxed on nothing, or I can get something that's tax-free and pays me more. By the way, the strategy I'm about to teach you, I remember I had an investor. He was bragging about how he was worth $20 million and how he was super smart. It was after just talking for a few minutes, he realized, dang, Chris, you don't talk like a smart person, but you're brilliant. And we found out that for him to do the same strategy I'm about to teach you, he would have to find a savings account paying him 5.5% a year. By the way, good luck on that, guys. I mean, I can find 2% or more online savings accounts, but 5.5% won't happen. So this is how we're going to do it. And this is very different. Even those of you that have heard about this, and by the way, just on the chat here, how many of you guys have actually been taught a strategy like infinite banking or cash flow banking or wealth formula banking? By the way, I've actually been behind most of these names, except for infinite banking. That's been around longer. Nelson Nash, how many of you guys are familiar with these kind of concepts?
Yes, bank on yourself. Correct.
Bank on yourself. Yep. Nelson Nash. Yep.
Someone says I'm not familiar with them.
Okay, great. Well, good, because I'm going to teach it differently anyways. Nelson Nash was kind of the father of this. He taught this years and years ago, right? Now, he was teaching things like using your life insurance as a savings account and then borrowing money from the insurance company to then go and basically like do a line of credit, right? And that's pretty much all we're talking about doing here is doing a line of credit. But I do a little bit differently. I don't buy cars with this. I don't buy houses because the truth is I can get cheaper money with the bank in some cases. So for that stuff, I don't use it for that. The Nelson Nash concept, by the way, was the one I was taught. And I'll tell you, like, I thought it was the coolest thing ever. And this is back in 2006, right? Some of these guys who were millionaires are like, hey, this is the strategy we use. And so I listened. Because obviously I was thinking, hey, these financial advisors don't know crap. Let's listen to these guys. They actually have money. And so anyways, like, these guys, I remember they telling me one of them referred to that was a life insurance agent.
Yeah, they're down. They are building some sort of park down by this.
Were they?
So anyways, yeah, I don't know what's going on at the park, but all right. So anyways, so he basically they're selling me on this whole life concept. And I remember asking, because I'd been an insurance agent for 4 years. I knew about things like overfunding and things like that. Well, this insurance agent, he told me, no, you cannot overfund because otherwise it'll become taxable. So I took him at his word. This is in 2006. Now I started dumping in a lot of money. I dumped in over the course of a couple of years about 25 grand. After those few years, I had a few $100 in it. Well, recession hit. And at that time, I actually was able to retire in 2006. That was the first time I retired. Went through the recession, went from millionaire to upside down millionaire, where I was in the hole $16,000 a month. I couldn't really afford to pay those premiums anymore. So I ended up losing the policy because I had no cash in it. Now, what ended up happening is later that year, I found out that he lied. He kind of did a half lie or a half truth, depending on which way you look at it. It's like a glass half empty or half full. He was accurate in saying that you don't want to overfund it doesn't become taxable. But he wasn't accurate in the sense that I could have overfunded it and made this thing grow faster. And so everything that we're taught, all the Nelson Nash people, they were teaching, this takes 10, 15 years before you have some cash in here. Well, I found out I could do a lot faster. And I confronted him about it. And of course, because I'm an insurance agent, and I've been an insurance agent for 17 years or insurance licensed, I confronted him about this. I said, listen, I know how this works. There's something not right here. And I bet you I could do better. He said, well, you got to make sure you have all these parameters. And so I did apples to apples comparisons. I not only had more death benefit than he had, but I had way more cash value. And especially if it were like the recession where I needed cash, I would have been able to keep my policy instead of losing all that $25,000 I paid in premiums. That basically made like an expensive term policy, right? And so I confronted him about it, and I got rid of every one of the excuses. This was a 2-hour debate we had in the office where I'm screaming at him. And at the end of it, he finally just said, Chris, the reason I did that is because I cannot afford to cut my commissions. At that point, I just wanted to just deck him. I was like, dude, I will never send you a referral again. And I never did.
Now just told you that point blank.
He told me that point blank because he ran out of excuses. He just said, I couldn't afford to cut back my commissions. And I'm like, well, that's why. And by the way, to this day, the guy still struggles. He was doing great, but again, that just didn't work. And so that's where it changed for me. I really got on a mission to teach this differently and teach it not from an insurance person's perspective, because they're really the big reason why this is not taught. One, insurance companies don't want to teach it because it doesn't really make them the money. You make more money when you do the strategy. Two, the insurance agent doesn't make more money. The reason I don't give a crap is because I'm already retired again. I was able to retire 2 years ago. I have plenty of passive income streams coming in from my business, as well as from my investments and things like that. So it was actually 2 years ago, that guy that said I was surprised how smart I was. That guy, he actually got me to come out of retirement, said, hey, let's all these investors and things like that, because I can show people how to do it with a cash-rich policy. And so that's what we do. So rather than just putting money in the savings account that you go in and invest and you create cash flow, you notice in this picture here, the money, we just add one more thing. We just put the money in, from savings, it goes right into this high cash policy that's earning tax-free dividends. Like I said, this is like a supercharged savings account that's earning tax-free money. Then you borrow the money from the insurance company, so the money's still in there. It's still growing and compounding. Remember we talking about compound interest? It's still compounding in there, the full amount. So say you have $100,000 of cash in here, you borrow $50,000. It's not like when you withdraw money from savings account and you have to build it back up slowly to start earning interest again. This one has the full $100,000 still earning returns. But you just get a loan from the insurance company like a line of credit. This is just like getting a home equity line of credit to invest. But the difference is this home equity line of credit's paying you at the same time because you're still earning dividends on it, tax-free dividends. So you're earning money while they're charging you interest. And by the way, here's the cool thing about this, is that it not only does that, but this loan, there's no payment required. So it's a private, like it says on here, it's private. There's no credit check. There's no effect on your credit report. It's a private loan with the insurance company. They don't even care if you pay back monthly. So with a home equity line of credit, like a HELOC, you take that out, you got to start paying it back monthly. Even if, and Gary, you know this, like if you've done deals where you've had to go and you know, done a fixer upper on a property before you can start renting it or before you can flip it, you know that if you have to borrow money, you're paying on that money, aren't you?
Yeah, that's right.
Yeah, but here, they don't require a monthly payment. Worst case, they require you to pay it at death. So when you die, they just take the loan out from your death benefit. Not even just from the cash, but from your death benefit. And so it's tax-free. It's protected from creditors and lawsuits. In over 30 states, it has 100% protection, meaning that you could have millions of dollars in this, and if somebody sues you or a creditor tries to come after you, put a lien against you, they cannot get to this money. No one can. For that reason alone, that's why that investor is like, hey, if I can be fully like, he's like, wait a minute, if I do this, if I go and I finance property, 75% financed by the bank, I have to put down 25%. If I'm borrowing this from the insurance company, I'm technically 100% leveraged, right? I'm like, that's correct. He's like, therefore I have no equity. So they can't sue me, can they? So even from that standpoint, it's pretty cool. Guaranteed growth is always guaranteed to grow. There's no fluctuations, no market stuff, not like the index universal life that I used to sell, which, you know, I noticed as I started to learn more and more about it, there was holes. There's things that made it not work as well. By the way, you can't do this whole compound interest thing. There's actually one company, and now they even created their own company, a new company now, old friends of mine. I taught the strategy to. They try to use it with IULs, but the problem is that they didn't understand the concept. It doesn't actually work with IULs. There is no compound interest effect that works here versus the simple interest thing. So anyways, a little bit different. But here's the cool thing, and Gary mentioned this in his email. You can get access to the cash now, sometimes within 30 days, sometimes within a few weeks. I've had several clients where they've dumped in maybe 40, 50 grand and then borrowed money right back out. They might have pulled out like 30 grand right like the next week after they put it in. So this whole purpose of this is—
Chris, this is the part that blows my mind. And because I've seen some do this, but you've got to have your money in for a year or 2 or 3.
Sometimes.
So, yeah, so I'm interested to know, you're the ninja that knows how to do this with, you know, it's kind of what you know and how you know to implement it. So I'm glad you're sharing this.
Yeah. So yeah, I mean, give you an example. I mean, most people that talk about the infinite banking concept, right? When they do that, and even people that have been popular out there, and I know a lot of these people that are out there teaching this stuff. The one thing is that you usually won't have access in the first year. See, whole life works a little bit different. Whole life is expensive up front, but then it gets cheaper as the years go on. Universal life is the opposite. It actually gets more and more expensive every year. That's why it doesn't work as well either. But whole life gets expensive the first year to 2 years, and then gets super cheap from year 3 on. And so usually the first year, say you dump in $50,000, you might only have access to $25,000 to $30,000. And most people would think that's amazing because, by the way, normal whole life, you dump in $50,000 that year, you have zero in the first year. You dump in $50,000 the second year, you might have $1,000 or $2,000 max. Even with infinite bankers, you might be lucky that by the second year, you might have, if you dumped in 100 grand, you might have roughly about 70 grand in there. The way I do it is different. I found ways to like get really creative, and it's always about the design and how you make it work. The first year, usually people, if they put in 50,000, they'll usually have access to at least 37 to 39,000 right from like day one. The second year, it's even more. I mean, they put in that full 100,000. They might have at least, usually at least $80,000 in there. By the way, usually when it takes 17 years to break even, so say somebody puts in 10,000 a year for 17 years, they've put in 170,000, they'll finally have 170,000 after 17 years in a normal policy. Even bankers, it might take 7 years before they will hit it. For mine, usually 5, maybe 6 at most. And so everything's just faster. And what happens, because you have more access to cash, because there's less money coming out for insurance costs, this allows you to create this like a real tax-free type of savings account that, again, can be used right away. And what we do is we take the cash flow, you'll see this in the diagram here. We put investment, the cash flow, instead of just putting it back into your savings account, we put it back into the policy. And what this does, this creates that simple interest effect where it pays the loan down. So now what happens, you start paying yourself back. And just like with a line of credit, right? You pay principal to the line of credit. What can you do after you pay it down? Charge it right back up, right? You could do it again. And so as you're paying it, and by the way, unlike 401ks, you can have many, many loans out all at the same time. It doesn't have to be just one that you have to pay off. You have multiple loans all outstanding at the same time. But again, the key to make this work is the cash flow goes back in. And even if it's not a cash flow thing, maybe you're doing what Kiyosaki would call a capital gains investment, right? Where you're doing like a fix and flip on a property. Great. If it takes a year to 2 years, perfect. I had a woman who came up to me at a dental conference for they're like people learning to invest that are dentists, right? And I was there and she said, "Hey, Chris, last year I used my policy. I borrowed $125,000 to do an investment with my son. Well, it's been a year later. We sold the property. We made $155,000. So Chris, should I put the money and pay back the loan, or should I go and invest it again? Because I already know where the money's going to go. I already have the next thing to deploy it into." And I said, "Well, don't even worry about paying back the loan because you're going to pull it back out anyways. Just go and invest it. That's the beauty of it. You don't even have to pay it back. Now, it helps if you do, right? It helps improve the numbers more, but you don't have to." So let me give you another real life example here. This is one I was just using one of my turnkey providers that I use. They had a single family home and they had a duplex. So I wanted to get as close to $100,000 as we could get here. So it was about $95,000 down payment between these two properties. The cash flow, the net cash flow on these properties is $1,070 a month. So I wanted to compare. What if I just, took $95,000 out of savings, took that $1,070, put it back into my savings account, building it $1,000 a month at a time, versus just using my life insurance to do the same thing. You want to know the difference? After 10 years, right? So after 10 years of doing this, here's the difference. The net gain, just by using the whole life, was $21,000. That's a 22.5% extra rate of return. So what happened? We double dipped. We double dipped our investment returns because that money was now used. Cash flow just flowed right back into the policy to pay it down. And what ended up happening is ended up having over $21,000 more. That's like getting an extra 22.5% for free. By the way, that's for a lot of people, that's a down payment on another extra property right there. That's more cash flow right away by doing nothing different than what you do with your savings account. We're just using a different vehicle and we're just doing a slightly different strategy. That's all it is. That is the power that you can create from this. So that's the whole thing. Again, we're making money on one side with the dividends of the whole life, because the whole life dividends are making more money than you're paying on it. And you have cash flowing investments. It's not either or anymore. It's not like, do I put money in the life insurance or do I put it in these investments? It's about doing both. How do we flow the money through here and then right back out to start getting those investments to pay us now? Acceleration, not accumulation. Get that money to pay us now, and then the thing just turns and turns, and it's freaking awesome. So who's this not for? I've had people where they're completely uninsurable due to health. I have one client, he's like 400 pounds. So even though he might be able to get some insurance, it would be really expensive. So what do? We put it on his wife, and then we put it on his kids. By the way, this is an awesome replacement for doing college savings, because how cool is it you can flow money through here and go and invest it versus throwing it into a 529 plan or something where you can't do anything with it and it gambles in the stock market and you hope that it's not bipolar the day that you pull it out, right? So it's not, so who's not for people that often have bad health, not great, but there's a workaround. We use it on people that we can use it on. Have people do it on their grandkids, you know. I'll tell you another, I mean, all the cool things we've done. I mean, it's incredible. I mean, I've had people use it like, I actually had a guy use it to get a loan on a building. He wanted to get an office building, buy a commercial space. He was going to office in part of it, but then rent out the rest. We were actually able to leverage with the bank, not even with the insurance company, with the bank. He was able to get a 3.25% interest loan on the building. He ended up getting a $375,000 loan for his building. That included a $50,000 build out. He did that. The payment was only $1,800 a month with the bank because they collateralized against the life insurance. And then after a year and a half, after he already finished all the build out and everything, he refinanced with the bank. They kept the same interest rate, the same payments, but then it freed up his cash again. So he had $300,000 of his cash available to use again. So it's cool stuff. Also, it would not be for anybody who's in a major cash flow crunch. I had a lady we're just trying to get her to $5,000 a month of passive income in the next few years. And we're just trying to use every dollar we can. And she's older. And so I just told her, nope. I mean, maybe term insurance for now, but that's great. By the way, term insurance can be a good thing, especially if you can get it to be convertible to the right kind of policy. You don't want just any term insurance. You want the one that converts to the right kind. I had actually one client that is up in Maine. He's a chiropractor and ended up getting a brain tumor right after we got the policies. And luckily, because he got the term insurance, he got the highest rating possible. So even after he got cured from the brain tumor, miraculously, he did a whole bunch of stuff to help cure that. He's uninsurable now, but because he got that term insurance already, he can convert that to whole life, and they can't take away his perfect health rating. So he can actually convert as if he was in perfect health. So it's pretty cool. But the real question is why wouldn't you use it, right? I mean, the thing is that this thing is awesome. It's not perfect for everybody. I mean, there's different situations where, like I said, sometimes term is better than getting whole life. But I'll tell you, in many cases, I have guys that are like that own massive real estate businesses that do hundreds of deals a year, and they're just dumping in cash left and right so they can pull it back out and double dip on their investment returns. So anyways, that's kind of how it works here. So anyways, I'm going to open up for questions.
Yeah, Chris, let me ask a quick question myself real quick. Sorry, I took my video off because my hotspot's really shaky when I use video. So anyway, what about people that are sitting and watching this or listening and they're going, okay, what if I only have like a couple $100 a month, or $2,000 a year I can put in this, versus someone that says I can do 10,000 a year or 1,000 a month, or someone that says 50,000 or 100,000. What is available to people depending on where they can play?
Yeah, you bet. I mean, usually if you got at least a few $1,000s a year, and by the way, this is a great replacement for a 401k, by the way. But if you can do at least a few $1,000s a year, I would say at least at minimum. I mean, depending on age and things like that. If you're younger, maybe 3,000 a year or so. If you're a little bit older, you probably want to do at least 5,000 a year, just to get the numbers to work out. Otherwise, I might recommend, finding ways to improve your cash flow first. Maybe just get term insurance, and then we can help work on increasing the cash flow. I had one client where we did that and got her cash flow increased by over $800 a month. And so it got to the point where she's like, okay, let's see what we can do about converting this term and make it whole life now. So, but yeah, on the upside, I mean, the max side, I mean, I've had clients that are doing $500,000 a year through these policies. And so there's so much flexibility in how you can create it and design it.
Can a person contribute monthly, or is it quarterly, yearly? How do they contribute?
Any of the above. Yeah. I would tell you this though. I mean, when it comes to ROI, if possible, I try to get people to do annually, and then save up the premium for the next year, because if you do annually, usually that first year I can increase the ROI by at least 5%. Right. So it can be a big deal. I mean, it's just like anything. If you do pay your car insurance annually versus monthly, you know how you save a little bit of money on the per month basis? Same thing with life insurance, but it's just amplified. So you could do monthly, but yeah, And another thing too is how I design these. I always reverse engineer it. So I don't worry about the death benefit as much. I worry about what's the max we're going to put in, and then figure out what's the minimum death benefit we need to get that max in there. That's how we cut the cost a lot, right? So for example, like I had a person recently where, let's see, I'm trying to pick one. Well, one guy, he was putting in 25,000 a year. His minimum is like 5,000 a year. So at any time, obviously we set up for 25,000 a year for so many years, usually like 7 or 8 years max. But at any time, like if he says, I can't do that this year, like things got tight or my money didn't come back from this investment yet, great. Well, can you pay at least the 5,000? Perfect. And by the way, even if you can't, if you get cash value, they can borrow from the cash value, pay your premium for you. And if it's after the third year, the way I design them, after the third year, it grows by more than what you put in. So if they have to borrow 5,000 for your policy, they just put it right back in anyways. So the money's going right back into your cash. But yeah,
nice.
there's so much flexibility in how we create it so that unlike my situation, like what I learned, we don't want to just, dump all this money that gets wasted and then you lose it because there's no cash in there. We try to create safety that there's cash that goes in right away. So if you can't make a premium payment, it can cover you in worst type of case scenarios. Best case though, we dump in a bunch of cash and we start double dipping.
So someone had asked if this is different, or how is this different than an IUL, what you're talking about?
Yeah, it is different. I know I mentioned a few things earlier. The IUL, basically IUL is just term insurance that renews every year, right? And of course, every year you get older, it gets more expensive. So what happens in the IUL is that you can design it and kind of make it work, but it doesn't do the double dipping. Because, for example, the whole life, the difference is that when they lend you money, they're still paying you interest. When you borrow from an IUL, they credit interest. And so in a best case scenario, they have what's called a wash loan, right? You might have heard where it's like a 0% loan. They don't pay you. They just credit to the interest rate. So there's not actually payments happening. They're just not charging you interest. They're just saying, hey, it's credited, so it's just 0% loan. So it means there is no compounding effect happening with that money that you're leveraging. So you wouldn't want to use that. Also, IULs have like massive surrender fees, especially in those early years. They limit you from touching that money early on. So you have to keep it in there a long time to even get access to the cash. There are no surrender fees. There's nothing weird like that with whole life. And like I said, whole life insurance costs go down where because of the term costs in IULs, they go up over time. By the way, if you have a bad performing market where it goes flat, like it did in the 70s, where it was like basically 0% return in the 70s, the IUL will lose money. It will actually lose money because the costs are still coming out, but you're not really making any money, right? By the way, the depression would have been great. That's why when they show you the depression numbers with the IULs, it's like, whoa, I would have made so much money. Well, yeah, when you lose 90% in a couple of years, you got to make 900% to get back. So you're like maxing that thing out every year. It's kind of deceiving to show those numbers. Like you show somebody a flat market, and you'll see an IUL that sucks.
I see. Anyone else have some questions for Chris while we got him with us? You can come off mute or type them in the chat box. I said we pick your brain as much as we can while we got you live.
I agree.
How can people reach out and connect with you, or how can people do you offer something that gives them like a kind of a free consultation or some type of a game plan, so to speak?
Yeah, I do. Yeah, definitely. Yeah, definitely with what I do here, I typically will. You just shoot me an email. Just shoot me an email, Chris, CHRIS, at moneyripples.com. That's MONEYRIPPLES.com. And shoot me the questions. Even if you've got a policy already, whether it's an IUL or a whole life. I've had several people have come to me like with Northwestern policies, for example, and we've looked at those and we're like, dang, even though you've put into it for 5 years, we could kind of jump out of the slow lane, get into the fast lane and surpass those numbers fast. So I've had people where like we've seriously found out like, I even had a policy that came my way recently that was from a friend of mine, and she was actually the one that wrote a policy on Robert Kiyosaki, Rich Dad Poor Dad, right? And I was kind of disappointed because she set it up kind of crappy. And So we look at that situation like, well, should we replace it or not? I end up not doing it because one, she's a friend, but two, he had been in it for so many years, like it was like 7 years, that it would have taken 8 more years for me to catch up and then beat the numbers. So I just told him, don't worry about it. It's fine. But yeah, I had somebody who just did one a couple months ago. We ended up changing that. I see that there's a question on here. Is this using the level paid up riders or for accelerated? Basically, it's just it's a little bit different in how I do it. They are paid up riders that we use, but they're not just level. And I designed it very specific on how to get the max cash out of it. So but it is pretty much a level paid up type of rider. So it is. So if, like I said, like the max, I set the max for usually 7-8 years at the most, and then minimum fund it the rest of the years. Oh, by the way, cool thing, you can actually stop paying altogether. You can actually make it a paid up policy at whatever age you want. So I've got some people after 7 or 10 years saying, okay, I'm done. No more premiums put in, and they just leave it alone. Just let it grow. So there's all kinds of flexibility and ways you can make this work that really just, I've had very few people come up with a good reason not to. Okay, I see another question from Josh here. It says, so if you have 3,000 or 5,000 to start off, would you suggest to pay the premium payments up front annually? Even if it's only 3,000 or 5,000, that would fund the policy to get started, or do you need more to get it started? Josh, no, you can definitely start with 3,000 or 5,000 to start it off. I was going to use this example. Sometimes I've had people where they were going to do a max fund of a certain amount, but then they didn't have all the money available at that beginning. And so we at least started with just the minimum to get started and then put in the money later throughout the year. So
yeah, that is nice. You can have a max range and a min range, and that's how we set ours up. So we can, when cash is there, you can fund it fully, and if it's tight, you can fund it minimally, but you can even play catch up down the road.
Exactly. It's interesting because when I used to sell IULs, I would tell people that's the whole reason why you get an IUL, right? Because you have the flexible premiums. But the thing is, the way I did the whole life, I made it to where it's super, super flexible. Usually it's the minimum's about 20 to 25% of whatever the maximum's set at. Like it's very much more flexible than normal. And by the way, the actual rate of return on these policies after fees and everything else, and these are like steady type of guaranteed returns or even steady returns that they've been getting. They usually will end up after like a number of years doing like 5.5% per year, tax free. And so I know sometimes people say, hey, with my IUL, I can get this. It doesn't matter because after you factor in fees, it usually is less. And by the way, I can still write IULs. I just choose not to. Only in some situations have I done it. Cool. Other questions? I did. I noticed I froze for a little bit. So yeah, I just asked if there were any more questions.
You totally froze, it says. I wasn't sure it was my computer, but you did freeze on my end. You froze on everyone's end.
Well, it's cold out here in Tampa. It's like 55 degrees out here. Come on.
I hear you.
Yeah, what I was just saying about the return is that the return is like I said, like it could be like 5.5% after fees are factored in and everything after those are taken out. With an IUL, usually you won't even get that high. It's usually pretty rare when you factor in the fees to get that high of a return.
Excellent. Anyone else have any other questions?
Yeah, any other questions?
So you're recording this, right? I'm going to be able to share this with a few people that couldn't be on, and we'll make sure we get it out to some other people.
That'd be great. And I know you mentioned there's people like insurance agents that if the insurance agents have questions, don't be shy. Like I have nothing to hide. I totally love sharing this stuff, but I'll tell you, like if you're an insurance agent too, you could be doing it so much better. Because the one thing I definitely guarantee for any of you guys watching this right now is that whatever the numbers are, I will do better. Every time I've been in a case where it's been like a toe-to-toe type of thing where they say, hey, here's what so-and-so sent me, I've always come back at least in a few cases the same because it was like the same company and everything, but usually I come back better. So it's that's the one thing I guarantee is that you're going to have the most cash-rich policy possible because, like I said, I don't mind, I don't mind designing it in a way that actually pays me less. Oh, and I learned a secret. The secret of abundance is that when you actually give people more of what they want to do more anyways. So, give you an example. I had a real estate investor who he was only doing 5,000 a year with his other agent who supposedly was supposed to be a banker. He talked about being a banker. He actually worked with a real estate company that you and I know, Gary. He was doing a lot of policies for those people. And he's like, oh yeah, I do infinite banking policies. And well, it wasn't. And what ended up happening is after, my friend who's again, owns a real estate company saw it. He's like, dude, I'm going to do 10 times that. I'm going to do 50,000 a year, maybe even 100,000. He's like, I'll start with 50,000 now, but I might get a second policy for another 50 just because I know I'm getting the money. Like I was hoping the whole time. So the ironic thing is I actually made more than that guy did, but that's only because it was giving him more money. And so it was the perfect win-win abundance mentality that you and I teach about all the time. It actually works in real life, So, okay, you asked, Remy asked, can you look at a current whole life policy and analyze and tweak if needed? Absolutely. By the way, I am independently brokered with several companies, so it might even be a company I work with. But yeah, I could definitely take a look at it. So like I said, just email me, chris@moneyripples.com.
Excellent. Yeah. Appreciate it, Chris. Really doing that. It's getting dark on me. I'm disappearing on the screen. I might as well turn my video off now. I'm sitting in my vehicle. I'm driving from I'm parked right now, but I'm heading to Logan to one of my flip projects. So,
oh, awesome.
Just, hitting the road.
Yeah, you can always have the yellow golden hotel light that I got here. It's so sexy.
Yes, you do look like you're from another planet right now.
I have that
kind of
Trump
greenish
glow about
gold.
me. What can I say?
That is awesome. Oh, thanks for putting his email on there, Anthony. That's awesome. Chris@moneyripples.com. And have fun in Florida. I know you're at the Collective Genius Mastermind. With tell you what, there's some good people that go to that, and I look forward to going there one day myself. But
yeah,
it's pretty neat, high level entrepreneurs and investors. That's awesome.
Yeah, looking forward to it.
Yeah, have fun, brother. Any other last parting words of wisdom?
Nope. Again, Gary, thanks so much for having me here. I appreciate it. I love teaching. I really do. And I'll tell you, like, I see it all the time. Like people, like many of you guys have been reaching out, sending me emails. Like, I'm so glad when you guys do, because I can seriously sometimes save people thousands and thousands of dollars. And therefore they can make thousands of dollars in return. So again, I love teaching people about, getting them more cash flow, more speed, and ultimately getting your dreams faster. So I appreciate the opportunity that you have me teach you because of that.
Yeah, that's awesome. Thanks. And you're welcome, Josh.
Yeah. Thank you so much.
All right. I'll let you hit a recording this tonight. Appreciate it, my friend.
You betcha. See ya.
All right.